This program provides education, not advice. Sponsors pay a fee for endorsements and interviews. See the truthayf.com disclosure page for details.
This is where technology, innovation, and personal finance come together.
This is The Truth About Your Future with Rick Edelman.
The Truth About Your Future is made possible by Invesco QQQ. The future isn't scary. Not realizing its potential, however, could be. Invesco QQQ. Let's rethink possibility. Invesco Distributors, Inc.
It's Friday, September 6th, and I want to talk with you about investing in the stock market. Now, this has been a lot of conversation lately because the stock market's been doing absolutely fabulous this year, and there is broad investor sentiment that there are high expectations that the stock market is going to continue to do even better. That, you could argue, is a contrarian argument, the so-called investors climbing the wall of worry. There is no wall of worry right now. Investors are very bullish and very optimistic. Well, that's all kind of short-term stuff. I'm not terribly focused on what the stock market's going to do in the next couple of weeks or couple of months, or how the election outcome is going to impact the market, blah, blah, blah. I'm a long-term investor, as you know, and I'm more interested in what the market's going to do over the next decade or half a century than I am about the next 6 months. So let's just talk about fundamentally how you invest in stocks. And the typical approach that I espouse, that I think most financial advisors espouse, is broad-based diversification. And there's nothing new to this. We've been espousing this for my entire career of 35 years. The focus is simple, instead of trying to pick the winners, instead of trying to decide which stocks are going to do well, let's buy all of them, or, the big bulk of them, 12 eggs in 12 baskets, so to speak. So let's diversify. This reduces our risk, because if one particular stock collapses, goes broke, loses a lot of value, so what? It's only one out of many, as opposed to having all of your money in a single stock where a loss would be catastrophic. And when we look at that, we take a broad look at the market, and you have basically two choices. Are you going to invest in big companies, or are you going to invest in smaller companies? And the simplest, easiest proxies for figuring that out is choosing between the S&P 500 or the Nasdaq 100. The S&P 500 are the 500 largest stocks that are in the country. These are known as big cap, meaning large market cap. These are companies that are worth an awful lot of money, companies like Apple and ExxonMobil. And then you have the Nasdaq 100. These are the companies that are trading on the Nasdaq as opposed to the New York Stock Exchange. The Nasdaq exchange generally, not always by any stretch, but generally houses smaller companies. And the Nasdaq 100 is considered the biggest of the smaller companies. And these are often also technology companies. Historically, tech stocks would choose to list themselves on the Nasdaq as opposed to the New York Stock Exchange. So these are more considered small cap stocks, smaller companies there. So you can choose between big companies and small companies, and that means choosing between buying the S&P 500 stock index or the Nasdaq 100 stock index. What I want to do for you today is give you a little bit of a spin on this idea, a little bit of a tweak on the popular and common notion of investing in a combination of big cap and small cap. It's not a question of choosing between the two. It's a question of doing a bit of both, right, for diversification. But I want to give you a little bit of a tweak on that, courtesy of two ETFs that are offered by Invesco.
I've got more on this in 60 seconds.
You're listening to The Truth About Your Future. We'll be right back.
The Truth About Your Future with Rick Edelman is brought to you by Schwab. With Schwab investing themes, it's easy to invest in ideas you believe in, like online music and videos, artificial intelligence, electric vehicles, and more. Schwab's research process uncovers emerging trends. Then their technology curates relevant stocks into themes. Choose from over 40 themes. Buy all the stocks in a theme as is, or customized to better fit your investing goals. all in a few clicks. Schwab Investing Themes is not intended to be investment advice or a recommendation of any stock or investment strategy. Learn more at schwab.com/thematic investing.
Welcome back. The Truth About Your Future continues. I'm Rick Edelman.
So I want to give you a little bit of a tweak on the popular and common notion of investing in a combination of big cap and small cap, courtesy of two ETFs that are offered by Invesco. Invesco, of course, as you know, is one of the sponsors of this podcast, and they offer two ETFs that I think are really worth you paying some attention to. The first is the Invesco S&P 500 Quality ETF. The symbol of this is
SPHQ.
The link to it, by the way, is in your show notes. This is an interesting ETF because it does something a little bit different that actually has a profound difference. The little bit of a difference is that it's an S&P 500 index fund, but it doesn't simply buy the 500 stocks of the S&P. It doesn't merely replicate the S&P 500, which is what dozens and dozens of index funds do. What it does instead is that it filters those 500 stocks to create a quality score for each one of them. And it produces this quality score based on three measurements: return on equity, accruals ratio, and financial leverage ratio. Well, what on earth are all those three things, and why should you care? Well, let me give you just a very quick, very brief description of each of the three. Return on equity. That's a measurement of a company's financial performance based on its net assets. You simply divide net assets by shareholders' equity. Shareholders' equity is the company's assets minus its debt. So the return on equity lets you gauge a company's profitability and how efficiently it generates those profits. The higher the return on equity, the ROE, the higher the ROE, the more efficient the company is at generating income and growth off of its financing. And to know whether a company's ROE is good or bad, you just compare it to other companies' ROE that are in the same industry. You need to compare a computer stock to a computer stock, an airline stock to an airline stock, a tech stock to a tech stock. You really can't compare an automotive company's ROE to a retail store company's ROE because they all get different measurements, different metrics. So you simply need to make it apples to apples comparison. Simple and easy to do. But it's a really easy, quick measure to help you determine if a company is good at generating income and growth off of its financing. The second is the accrual ratio. This lets you know if a company has a lot of non-cash earnings. You take the company's net income, you subtract the free cash flow, and then you divide it by its total assets. This formula has been around for almost 30 years. Wall Street uses it routinely. The research tells us that companies with small accruals vastly outperform companies with big accruals. So it's another easy way to gauge how good is this company operating. And the third is the financial leverage ratio. It measures a company's debt in relation to its other financial metrics, like its capital structure and solvency and how it finances its operations. You get the financial ratio by dividing the company's total assets by its total equity. A lower ratio means less debt and less risk. Higher ratio means more debt and more risk. So when you're looking at the S&P 500, the list of 500 stocks, it ignores all three of those because the S&P 500 is merely a list of the biggest companies ranked by size. But the Invesco S&P 500 Quality ETF filters those 500 companies based on their scores on return on equity, accrual ratio, and financial leverage ratio. And it only invests in the 500 companies that score well. And as a result, it doesn't own all 500 of the S&P 500 index. It only owns about 100 of them. The other 400 don't pass the test. So that's a pretty interesting filter result. And how is that translated in terms of investment performance? Well, as of the end of July, Morningstar gave this fund 5 stars for the past 3, 5, and 10-year periods. I mean, it has really trounced the S&P. Year to date, the S&P 500 is up about 17% as of the end of July. This fund's over 20% in return. For the past 1 year, it's up over 25% versus 22% for the S&P itself. It's up 11% over 3 years compared to 9.6 for the S&P, and it is up 16.1% per year over the past 5 years compared to just 15% for the S&P 500 index itself. So its track record is clearly demonstrated that this filtering results in you owning the stocks that outperform the index itself. Now, of course, this is past performance data. We know that past performance doesn't guarantee the future, and any assertion to the contrary is a federal offense, but still, I find it noteworthy, and that's why I mention it. And again, the fund is called the Invesco S&P 500 Quality ETF.
The symbol is SPHQ.
The link, again, is in the show notes. The second ETF I want to mention is Invesco's QQQM. This is the Invesco Nasdaq 100 ETF. Now, this does reflect the 100 companies, the 100 biggest companies that are listed on Nasdaq, excluding the banks, because banks are a whole nother beast. Their financial performance and operations are entirely different. So the Nasdaq 100 excludes the banks and financial stocks. And what you're left with are the 100 companies on the Nasdaq other than those. So this is just, I'll put it in quotes, just the Nasdaq 100. And QQQ's been around for decades. Invesco created QQQ back in 1999. It's now one of the 5 largest ETFs and one of the best performing, for the simple reason that these small tech companies have largely outperformed the overall market. You know, we all know this about Apple and Amazon, and the list goes on and on and on. So why am I talking about QQQM if QQQ's been around since 1999? Well, when QQQ was invented way back when, the pricing structure for ETFs was different, frankly, higher. So that fund's been around since 99. In 2020, Invesco created a cousin to QQQ called QQQM. The difference between the two? The fee. That's the only difference between the two. QQQ is pretty darn cheap. It's 20 basis points. 0.2% is the annual fee. That's really quite low. QQQM is even cheaper. It's 25% cheaper. It's only 15 basis points, 0.15% per year in fee. So rather than owning QQQ, which itself is a pretty darn good and common investment for people to own, you can save yourself 25% of the fee by investing instead in QQQM. It's really that simple. The link to it is also in your show notes. You can learn about both of them, of course, along with everything else about Invesco at Invesco.com. So if you're looking to own a diversified spread of the market, simply, easily, quickly, without any complication, you do a combination of the S&P 500 and the Nasdaq 100, and Invesco offers you 2 pretty easy and clever ways to do it: SPHQ and QQQM. Hey, I got a question from Alan in Irvine, California. I'm going to give that to you next.
Electricity, a big idea that's inspired countless new ones. From powering the light bulb to virtually powering our entire lives. 30 years ago, State Street launched the Spider S&P 500 ETF, SPY. A big idea that inspired the world to invest differently, and still does. What can you do with SPY?
Before investing, consider the fund's investment objectives, risks, charges, and expenses. Visit ssga.com for a prospectus containing this and other information. Read it carefully before investing. SPY is subject to risks similar to those of stocks. All ETFs are subject to risk, including possible loss of principal. Alps Distributors, Inc. Distributor.
Support for The Truth About Your Future with Rick Edelman comes from Invesco QQQ. 25 years ago, Invesco QQQ rethought the investing landscape by providing access to the Nasdaq's 100 most innovative companies, all in one ETF. What's ahead for the next 25 years? Could it be flying cars, neural implants, electric planes? Nobody knows for sure. But one thing's for certain. You can gain access to that progress with Invesco QQQ ETF. Let's rethink possibility. There are risks when investing in ETFs, including possible loss of money. ETF risks are similar to those of stocks. Investments in the tech sector are subject to greater risk and more volatility than more diversified investments. The Nasdaq 100 Index comprises the 100 largest non-financial companies on the Nasdaq. You can't invest directly into an index. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Visit Invesco.com for prospectus containing this information. Read it carefully before investing. Invesco Distributors, Inc.
Welcome back to The Truth About Your Future.
I got a question from Alan in Irvine, California.
I was listening to how Elon Musk used AI to spoof a speech by Kamala Harris. It got me thinking about how it's hard to decipher between what's real and what isn't anymore. And it got me thinking, how would blockchain technology help with this? Verifying the authenticity of what we see nowadays seems like it's going to be a new problem that needs to be solved.
Alan, I really think you're onto something, and this is why so many people in the tech community are looking at the merger of blockchain and AI for exactly the reason that you are citing. There are actually two reasons for this. Number one, both of these are technologically data centers. Blockchain technology uses mining. You've heard of Bitcoin mining. And AI uses data centers. These data centers demand a lot of energy. Bitcoin energy doesn't have to be on 24/7 because mining is an optional exercise. It can be turned on and turned off without anybody really knowing or caring. AI data centers, however, must be on 24/7. I mean, you need access to your cloud services all the time, don't you? So we can merge these two together technologically where one can support the other from a power perspective. Also, Bitcoin mining is often engaging with energy sources that are otherwise wasted. Those energy sources can be diverted to the benefit of AI energy production. So that's one area where blockchain and AI are merging together. The second is in data verification, which is the focus of your question. With data verification, it's becoming really scary due to all of the deep fakes that are available because AI can imitate voices and they can imitate faces thanks to video technology, and it is really rather scary. Well, one of blockchain technology's best attributes is authentication and verification. Once you put data on a blockchain, and that data can be text, the data can be audio, the data can be video, it becomes immutable. It becomes a permanent source of truth as to the validity of that data. So if you're worried that the video you're looking at isn't legit, if the creator of that video is legit, Donald Trump produces a campaign ad and you want to know, did Donald Trump really do it? Did Kamala Harris really say that? If Kamala Harris' campaign posts it, if Donald Trump's campaign posts it onto a blockchain, it becomes a permanent source of truth that anybody with an internet connection can verify because blockchains are decentralized. They are public ledgers. So you don't have to wonder, is it legit? You can verify it yourself quickly, easily, and freely. So yeah, I do believe that you're going to discover a greater new use of blockchain technology as a counter to the problem that we are beginning to experience as a result of the technological capabilities of AI. Watch for more. It's going to get pretty exciting. You can send me your question as well. Just send it to askrick@thetruthayf.com. The link is in the show notes. And as we enter the weekend, I want to remind you that coming out of the weekend, next Wednesday, September 11th, our webinar on the Fed rate cuts. Jerome Snyder from PIMCO is going to be joining me, and we're going to talk about this new interest rate environment. The first time in years, rates are coming down as opposed to going up. What does it mean for your investment opportunities? How much of your assets ought to be in bonds these days? New fixed income opportunities, how to adjust client portfolios, how much cash should you hold? We're going to cover all that and more. Your questions too. It's next Wednesday, September 11, 1 p.m. Eastern. Register right now. The link's in the show notes. Advisors, you get one CE credit. Have a great weekend. See you there.
How should you think about Bitcoin? Turn to a specialist. For 6 years, Bitwise has been helping investors access crypto. Bitwise manages the world's largest crypto index fund. They also offer 6 crypto ETFs. You get cutting-edge insights, expert Bitcoin research, and a nationwide team to help. Bitwise helps investors and advisors navigate crypto with confidence. Partner with a specialist. Look for ETFs backed by Bitwise. BitwiseInvestments.com. Carefully consider the extreme risks associated with crypto before investing.
I'm glad you're with me here on The Truth About Your Future. If you like what you're hearing, be sure to follow and subscribe to the show wherever you get your podcasts, Apple, Spotify, YouTube. And remember, leave a review on Apple Podcasts. I read them all. Never miss an episode of The Truth About Your Future. Follow and subscribe on your favorite podcast app.
How do advances in science, technology, and medicine translate into investment opportunity? Listen and learn.
This is The Truth About Your Future with Rick Edelman.